if now is not a time to raise cash, when exactly would one raise cash in this kind of environment?
RB Advisors' Richard Bernstein identifies the megatrends shaping the markets for decades to come.
Funding provided by ClearBridge Investments, the Fairholme Foundation, First Eagle Investments, Bill Miller, Miller Value Partners, Baird, Strategist Asset Management, Research Affiliates, Royce Investment Partners, Seafarer Capital Partners, and Women Investing in Security and Education.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. This week's guest has been a Wealth Track regular since we launched the show in 2005. He has provided sane perspective on the markets and valuable investment advice ever since. Given the turbulent geopolitical and financial climate we are now in, I asked him to join us once again. He is Richard Bernstein, an influential investment strategist who is global head of macro investing at Janus Henderson, as well as chief executive and chief investment officer at Richard Bernstein Advisors, which he founded in 2009. RBA oversees or advises approximately $20 billion in assets, largely in multi-asset allocation strategies for financial advisors using ETFs and separately managed accounts for institutions. In his previous life as Merrill Lynch's longtime chief investment strategist, Bernstein was inducted into the highly selective Institutional Investors Hall of Fame for his 18-year tenure on its prestigious All-America research team. He is known for his expansive macro analysis and thematic investing. In the first of a two-part interview, I asked him to talk about the big picture. What is his analysis of current market conditions?
So, Consuelo, I think that everything we've been hearing over the past 3, 6, 12 months are various symptoms of one problem. And that one issue that's confronting the global financial markets is that globalization itself is contracting, right? That wars don't happen when globalization is expanding and countries want to trade with each other, but whether it's tariffs or whether it's wars or whether it's the skirmishes that are going around all around the world, it's not just U.S. involvement, all around the world, these are all symptoms of deglobalization. And I think that's one of the main themes that investors have yet to embrace.
You know, it's so interesting because that is a theme. I mean, you are known, as a macro strategist and for your thematic investing. And that is a theme that you have been talking about, deglobalization, for years. The last several times you were on Wealth Track, you mentioned
absolutely.
that. And so it's like it's really coming home to roost. I mean, I never thought of a war in Iran as a symptom of deglobalization.
As you mentioned, this is a theme that we identified more than a decade ago. I mean, we didn't get the words exactly right. We didn't talk about tariffs. We talked about customs and duties. We didn't talk about supply chain disruptions. We talked about the risks of disaggregated production. We didn't get the words right, but we got the themes basically right. And it was our original assumption was that there was an investment theme growing because of the combination that the United States had this massive trade deficit, which we still have and has grown, combined with the beginning of deglobalization. And we just thought that an economy that is dependent on the rest of the world for virtually everything at a point in time where global trade is starting to contract, that was not a good combination. And there had to be investment opportunities surrounding that change in the global economy.
So, Rich, the investment repercussions, what have they been all along when you first started to identify deglobalization as a major secular trend?
There were kind of two embedded themes in what we thought was going to happen, and we still think is going to happen. We think we're in the midst of this right now, even though it's been going on for a decade. Theme number one was that the U.S. industrial sector needed to be modernized and needed to be expanded. That we all know, and we know this very well today, that our industrial base in the United States has been woefully depleted. There's no way the United States economy can compete on a global scale with 1960s and 1970s infrastructure. If there were any other thing we were talking about, we'd be laughing hysterically about thinking about competing with 1960s infrastructure. But that is what's happened in the United States. Woeful underinvestment in the industrial infrastructure. The second thing we thought that was going to manifest out of this was that people should be thinking in terms of higher inflation, not lower inflation. Now, that's not high inflation. I chose my words very carefully. It's higher inflation, not lower inflation, not high and low. And the reason I say that is that we would argue the number one reason that we had secular disinflation in the United States for so long was actually globalization. That what globalization simply did was increase competition. And I don't think anyone needs a PhD in economics to know that when you increase competition, you get downward pressure on prices. And that what globalization was going to do was to start reverse that we would begin to decrease competition. And as you decrease competition, you tend to get upward pressure on prices. So you could take this to an extreme, a very hyperbolic extreme, and say, oh, the United States is doomed, we're going to have 8% inflation. No, that's not the point. From an investment point of view, our consistent positioning has been to assume that inflation would be higher than people expected. That hasn't worked all the time over the last 10 years, but it certainly worked more than I think people realize.
Expectations count in the markets, right? Because
Absolutely.
many times investors base their decisions on what they expect to happen as opposed to what is happening.
Yes, exactly right. And I think it's always important to think about that relative expectations. It doesn't make a difference whether things are high or low. It's whether things are higher or lower than people forecasted.
What are you forecasting as far as inflation is concerned?
Well, I always make fun of people who make forecasts where they have the decimal point, right? We're expecting, 3.2 or 3.4% inflation. I always find that kind of funny. But, here's the way I would think about it. The Fed is still talking about a 2% inflation target. I personally think that's very antiquated. And so whereas the Fed might be talking about 2 to 2.5% inflation, I think it's better to think about 3 to 3.5 or 3 to 4 as your inflation target. Not, as I said before, it's very easy to get hyperbolic about all these different forecasts. But I think a percentage point higher as a secular trend is quite important. Now, that doesn't sound like a lot, but if you compound that out over 3, 5, 7, 10, 20 years, 1% extra inflation is very meaningful.
And does it change the equation as far as what investments are going to benefit from a higher rate of inflation, more inflation?
Not only does it benefit certain groups, but a lot of the groups that people now think of as being core investments have been big beneficiaries of that globalization trend, the downward pressure on interest rates, which allows investors to look farther out into the future. And, think about the difference between, say, a money market fund and a 30-year zero coupon bond. Obviously, one has a longer time horizon than the other. It's the same in the equity market. What lower interest rates have done in secular disinflation has allowed investors to think in terms of 30-year zero coupon bond equities, if you will. Very long duration, they're commonly called long duration equities with very long time horizons and uncertain returns up front, but very long time horizon type things. That's going to change. I think it already is changing, where things like dividends, short-term gains become much more important. The other side of that is what benefits. Well, clearly, it's pro-inflation type assets. It would be anything from material stocks and energy stocks to smaller capitalization stocks to countries that are very commodity-oriented and things like that. These are mostly investments that have lagged, and they've lagged because we haven't had that inflation tailwind.
This is something that you identified, as we said, like over a decade ago. It's been kind of simmering under the surface. So why hasn't it hit investments until like last year? And I don't even know if this was the cause of the fact that, that small and mid-cap stocks and international stocks and value stocks did better last year and outperformed the growth stocks for the first time in like over a decade.
Well, Consuelo, I think surprising to most of your listeners and your viewers is that small and mid-cap industrial stocks, which we forecasted to be the biggest beneficiaries of this kind of secular trend, have actually outperformed the S&P 500 over the last 10 or 12 years. This is the best performing, least watched theme out there that you could think of. And I think the way to think about it in kind of fun terms here for a second is, imagine going to a party and you say to somebody, I heard something new about AI. Well, you're going to be the popular person of the party. Everybody's going to circle around you. They're going to hear, what do you know about that? What's going to happen? Okay, instead of AI, try telling them a story about something like carbon wire or ball bearings. And watch them go, ball bearings? Like, what kind of growth story is there in carbon wire? What are you talking about? Well, those stocks have actually done very well over the past decade.
Emerging markets have not, however. Actually, you gave me a very interesting statistic, which I was unaware of. So about dividend-paying stocks, which was their performance.
Yeah, so dividend stocks are about as boring as you can get. And our theme for 2026 was boring is beautiful. And so, of course, we talked a lot about dividend stocks. And there's nothing sexy about them. There's no exciting story. They just pay out cash flow. And the point that I think most investors don't understand is that one of the easiest ways to build wealth over the longer term is the power of compounding of dividends. And here's my proof statement. Over the last 25 years now, the S&P Dividend Aristocrat Index is neck and neck with NASDAQ. I'm going to bet that not one of your viewers knows that, but it shows the power of compounding dividends, but yet they get no attention. And my argument has always been to kind of compound your dividends and go play golf.
No longer clip coupons, but actually reinvest the dividends.
Correct.
Exactly right. Keep
exactly right.
That power of compounding. The current state of the market, Rich, which people feel that is a very unsettling, very uncertain, very turbulent, volatile, everything else.
I actually think that this is a very unique period, Consuelo, in that the fundamentals, and we just limit this discussion for a second to the U.S. economy, that the fundamentals in the U.S. economy are healthy. Some are very healthy, some are a little less healthy, but nothing's in bad shape. Now, I know there's a lot of issues that go on about employment. Really, everything in the economy is at least healthy.
Right.
And the fundamentals of corporate profits and things like that are quite healthy, not only in the United States, but outside the United States. That positive story is being confronted by immense uncertainty, right? When we see things like oil prices jumping around 5 to 10% a day, gold prices jumping around 5 to 10% a day, the stock market jumping around by multiple percent a day, there's clearly a lot of uncertainty out there. I think that's the problem for investors right now, and how we tried to deal with that was we actually raised a small amount of cash in our portfolios, but did not change the fundamental positioning of our equities. In other words, we just literally sliced off from the portfolio about 5% and put it into cash, keeping that fundamental assessment that the economy is reasonably healthy, the corporate profits are quite healthy, but the fog of what's going on now, I mean, just simply put, if now is not a time to raise cash, when exactly would one raise cash in this kind of environment? So I think that kind of tug of war between the positives and the uncertainty are making this a very difficult environment right now.
What kind of cash positions have you raised in your portfolios?
Depending on the portfolio, we probably have between 5 and 10% cash now. I mean, we tend not to carry cash because we know over the longer term cash is not a very high returning investment unless one thinks there's going to be an outrageous amount of inflation, which is not our forecast at all. When money markets perform very well is when you have double-digit type inflation. So cash doesn't really help your portfolio over the long term. But, I always describe to people that everybody always talks about the possibility of return in a portfolio. Nobody really talks about the management of risk.
Right.
And as fiduciaries, we have to not only think about trying to get high return, but we should be trying to mute the volatility of that return through time for our investors. And so we do both. And so a little bit of cash seems to make sense over the last month or so.
So that's interesting. As you said, it's not about the fundamentals of what's changed. It really is about the psychology in the markets, right?
Our goal is just to mute the volatility. Everybody's seeing these huge moves up, down, up, down, up, down. We just want to mute that a little bit so everybody can sleep a little better at night.
Another interesting part of your strategy, Rich, is that I think you told me that you don't own any corporate bonds. Is that correct?
We have virtually no, I don't want to say no, but virtually no corporate debt. either high quality or low quality, investment grade or non-investment grade, in our
Why?
fixed income portfolios right now.
Why not?
Simply because spreads, in other words, the interest rate difference between corporate bonds and treasuries, is pretty much historically narrow. And there's only been 3 times in my career, which is now getting up well into the numbers. There's only been 3 times in my career where spreads have been this narrow. The first was prior to the Asian and Russian credit crisis of the late 1990s. The second was right before the global financial crisis. And the third was several years ago, prior to the inflation Fed rate hike scare in 2022. We started shunning corporate debt, not that we could identify a problem specifically, but we knew that we were not being compensated for any risk. So we didn't have to worry about the risk or a risk. We just knew we weren't being compensated for any risk. And I think when we did that 9 months ago or more, I can't remember exactly, maybe it was a year ago, people thought we had like 3 eyes. I mean, they were like, are you crazy? Why would you not be in corporate debt? Well, I think over the last 3, 4, 5 months now, people understand that they weren't being compensated for the risk and that something's more likely to pop up and sort of bite you in the tush when you're not being compensated for something.
So that's another indication, right, of an extreme. Is that right in the financial markets?
The word extreme might be a bit extreme. But I think that's right. I think that people have a very, when people are most enthusiastic and you think there is nothing that can go wrong, you just have to say, is there really nothing to go wrong? And what if something does go wrong? Am I getting any compensation for that potential risk? Generally when you're being, as an investor, as opposed to a trader, as an investor, you want to look for situations where you're being overcompensated for the risk. And it's clear in corporate debt over the past year or so that just wasn't true. You were being underpriced. Risk was being underpriced.
Where are the areas that you are being compensated for taking risk?
I think right now that universe in the equity market, that universe of opportunities might be historically broad. Right. If you think about that, we're coming out of a period where everybody talked about the magnificent 7 stocks, and there were 7 stocks. Our question was, are there really only 7 growth stories in the entire global equity market? That seemed really dire and unduly pessimistic. There's only 7 companies that could grow. In fact, there were many companies that were growing as fast, if not faster. It's just nobody cared about them. They weren't getting any headlines and there wasn't any price momentum in them. But there were many companies that were fundamentally even more sound than the Magnificent 7. So the opportunity set is very, very broad. And what you've seen this year when, as I said, the uncertainty has been mounting, the volatility has been rising, what you've begun to see, as is true in all historical periods, fundamentals start to matter again. It's not just about price momentum, it's about actual investment fundamentals. And so what you've seen this year is a almost dramatic broadening of the marketplace, where people are beginning to realize that there are many opportunities that are much more conservatively priced. So let me give you an example. The S&P 500 is trading still right now on trailing earnings. Maybe I'm overstating it. Let's say 23 to 25. You've got the equal-weighted S&P trading at 18. That equal-weighted universe trading, at such a dramatic discount to the market-weighted version, to the big stocks, tells you that if you're an investor, again, not necessarily a trader, but if you're a true investor, the opportunity set is huge.
How do you invest in the equal weight?
Yeah.
How do you take advantage of that?
The literal thing would be that maybe you want to buy an index fund tied to the equal-weighted S&P. They do exist. There are ETFs, index funds that do that. In a more practical sense, what it means is just don't buy those 7 stocks. I mean, if you're looking for new things to invest in, look at anything. Look at mid caps. Look at small caps. Look at non-U.S. There's so many opportunities here. You really don't have to try to pinpoint the opportunity. The
unsettledness that we've been talking about, the psychology that is turning much more negative. That we're seeing inklings of it. Is that true overseas as well in international markets?
It's a little bit different. I mean, if you ask non-U.S. investors about the United States, they look very much like U.S. investors. If you ask them about their local markets, they tend to be much more pessimistic, which I think presents this wonderful opportunity, is one contributor to the remarkable opportunity.
Some of the biggest performers recently actually obviously have been energy stocks as well. Do you have a sense that that's a short-term phenomenon, or is that also a higher inflation beneficiary that should have legs?
All of the above. I think that yes. Look, if the United States is going to have any inkling of reindustrialization, of rebuilding our industrial infrastructure, energy is going to play a critical role in that happening. However, one has to remember that things like the electric grid and 1960s, 1970s technology, it's remarkable to think about this. There's plenty of stories in energy to talk about, whether it's brown energy, whether it's green energy, whether it's electric, whether it's nuclear. I think there are tons of stories to be talked about here. But if you can remove the politics from an energy discussion right now, I think you should enter it with, it's not brown or green, it's brown and green.
Right.
And the example that I like to use, again, something that I'm going to guess most of your viewers and listeners don't know, is that on a normal day, Texas gets over 50% of its electricity generation from non-carbon sources. That is Texas. And they're about to overtake California in terms of battery storage. I mean, it shows you just that fact that on a normal day, over 50% of their electricity generation comes from non-carbon sources. The fact that nobody knows that shows how politics has skewed the economics. But investors have to be so dispassionate to see through all this to look for those opportunities. And I think, the energy sector, again, whether it's green, whether it's brown, whether it's electricity, whether it's nuclear, again, don't get too sexy on this one. There's lots of opportunities.
Right. And we all know that energy demand is going up, and energy is definitely needed, no matter where you live or what your political persuasion.
Absolutely.
Yeah. Any other sector that is that compelling?
The industrial sector itself, I think, is a very, very interesting sector, especially as I pointed out before, mid-cap and small-cap industrials. In particular, our index looks at mid-cap and small-cap industrials that get at least 75% of their sales from within the United States. So it's domestically focused industrials. I think that's a huge, has been and will continue to be a huge growth opportunity. I think if you look at the materials sector, we all know that there are various bottlenecks, some political, some physical bottlenecks that are popping up with all kinds of minerals, and I think that there's probably a story there. When
you're talking about materials, what are you talking about?
Yeah, materials would be anything like chemicals, metals. Basically the way I think about it is very ugly and dirty stuff.
Right, and again, it's not a sexy area. It's not an area that's gotten a lot of attention from investors.
Not at all. But that's what presents the opportunity.
Rich, one investment for a long-term diversified portfolio. What should we all have some of in a long-term portfolio?
From my personal point of view, it has to be something tied to this reindustrialization of the United States. And, small and mid-cap industrial companies have outperformed the S&P over the last decade, but they are flying well under anybody's radar. I just think it's a fantastic story. We know it has to happen. The United States, for national security purposes, for the health of our own economy longer term, we know this has to happen, but it hasn't really, even despite its performance, people still don't understand the critical nature of this theme. So I would say small and mid-cap industrial companies. Thanks
so much, Rich. And since we don't allow you to recommend a product of your own on Wealth Track, I want to tell our viewers that you created an index of small and mid-cap American industrial companies in 2014 that has performed incredibly well. And I'm going to recommend a product that represents it in my action point next. So thanks so much for joining us. Stick around because we're going to do part 2 of this interview, but our topic is going to be navigating the market noise. So I look forward to that. Thanks so much, Rich.
Thanks, Consuelo.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's Action Point follows up on Rich Bernstein's one investment recommendation to buy an overlooked sector of the U.S. market, namely small and mid-cap industrial stocks. So this week's Action Point is consider small and mid-cap American industrial companies. One way to invest in this sector is through an ETF based on Bernstein's American Industrial Renaissance Index. It's called the First Trust RBA American Industrial Renaissance ETF, and the ETF symbol is AIRR. It is rated 5-star by Morningstar and has delivered average annual returns of nearly 15% since its 2014 inception. That performance beats not only its small cap index benchmark, but also the S&P 500 over the same time period and for the last 3 and 5 and 10-year periods as well. Smaller American industrial companies are definitely worth a look. Next week, pioneering Asia investor Mark Headley is out of retirement and running portfolios again, why he thinks the timing is right to invest in Asia. Please follow us on Facebook, X, and our YouTube channel. Thanks for being here. Have a revitalizing weekend and make the week ahead a healthy, profitable, and productive one.